There he goes. There he goes. All right, so okay, cool. We're gonna do I meant to do a live Right Capital live stream last night during my live stream, and we got a lot of other topics to discuss, so we didn't get a chance to do any. So I'm gonna do a Right Capital live stream probably for about an hour or so, because I gotta go get my daughter over at Georgia Tech. Because when you have braces and you have other issues with your choppers, it costs a lot of money, my friends. Hey. The doctors should, the dentists and whatnot should be out there, and they should give me some money for my my retirement plan, because we are feeding them for sure. All right, so if you hear Pablo in the background, just ignore him. All right, so what we're gonna do? Let's see here. We're gonna bring up live. Okay, cool. We're gonna bring up live Right Capital, and you will see right. Oops, I guess I'm already there. Share. All right. So we're gonna bring up Right. How do I always forget how to get rid of this thing? Hold on a second. I want that right there. How do I get rid of this guy right here? Hold on just a second. We're going to bring up Right Capital. Someone had showed me how to do this. Now I forgot how to do this. Record, stop, disable, hide video playing. There we go. Okay. All right. So we're going to go to Right Capital. All right. Here we go. So we got Robin S. All right. So we got Robin S here. And Robin, we're going to show you. So what I do is you go to this is the dashboard, my friends. Right here is the dashboard. And this is where you plug everything in. So I get a lot of questions like, hey, if I got a savings account or checking account or something like that, what do I do? And this is where you just put all the info. So we see Robin's got a $24,000 checking account. I need to get my, there we go. All right, so Robin's got a $24,000 checking account. She's got investments of $408,000. We have a loan. We have a property of $350,000. As you can see here, current value is $350,000. Annual appreciation is 2%. So basically, what I've done here, let's just go back. I just want to make sure I'm in the right place. This is Robin S, and we're just saying that's Robin Scanlon for simplicity. We could call her Pablo. And what we do is under the dashboard, we go to profile. And all this is under the net worth. So we're under dashboard, we go to profile, net worth, and you just start adding stuff. So let's just say we have we want to add a mortgage, a second mortgage. We're going to go to add account, and we're going to say loan. It's not as conspicuous as I like, you see, but that's where it is. It doesn't say mortgage, it says loan, which is kind of odd. I think it should say mortgage, but it doesn't. So you go in there and just start typing out the info that's in here. It will calculate a minimum payment. So let's just say you have a loan term of I think you got to do 330 years. You don't have to do 30 years, but you just say 30 years. You can't do 360 payments. You got to do the number of years. And you say the interest rate of 4%. And we'll say we have a original amount, we'll say $200,000. And we'll say the balance right now is $150,000. And then we'll say our month, I think it actually saves it gives us a minimum monthly payment. I don't remember if that automatically shows up in the cash flow. Let's see. So we're gonna go to, I just can't remember. So we're gonna say that's Robin's, we'll call this second mortgage. We'll say it's a home equity line of credit. I think you go down here. Yeah, home equity loan. There you go. Sweet. There you go. So if you type on, you'll say mortgage, home equity loan, car loan, student loan, other loan. And we did that by going to add account loan. All right. So add account loan, that's how you add a mortgage right there. Always remember, when you're under the net worth side, you can add any kind of account you want: bank account, investment account. If you got investment property, vacation home, rental real estate, whole life, you have everything you could possibly add in here. On a side note, I don't put credit cards in. Credit cards, the reason I don't put credit cards in is because what credit cards do is they screw up the cash flows. All right, so the credit cards, you'll have your credit card in there, but it makes it seem like, I think it's like 1.5% minimum monthly payment. So if you have a $9,000 credit card, which you fully anticipate paying, okay, cool. If you fully anticipate paying it paying it off every month, it's going to act like that loan is in perpetuity, and you have a minimum monthly payment of $1,500, 1.5% every month for the rest of your life. So I would highly suggest you get rid of credit cards. I wouldn't put them in there. Now, if you have a credit card debt that you're working on, then go to add account and go to loan. And then what you'd want to do is just say, okay, we're going to have a other loan in this case. And you just say, my month, I have a balance of $15,000. I have an interest rate of 10. I have no early payoff. And we can say credit card debt and say it. I think, again, it gives us a minimum. It doesn't give us a minimum monthly payment. But in this case, you'll say your monthly payment is $300 a month or something like that. All right. Does that make sense? When I'm just using that for example. Hey, what's going on, CJ Poley? Anyway, and so oops, oh man, why I keep doing that? Oh, I floating meeting. Oh, there we go. Sweet. And so I'm just not a fan of doing that because it'll just screw up your cash flow. And if you add a credit card in here, hey buddy, it'll say card, and we'll say we have $15,000 here as a credit card, and we'll say we have a 10% interest rate. I think it saves it there. No, it doesn't save it. That's weird. We'll say $500 our minimum monthly payment. But anyway, I just don't like using them. So let's just get rid of that credit card and we'll just zero that out. All right. So it's okay, buddy. Hey, you're okay. All right. So let's go back to what the second mortgage did. This home, she has her first mortgage, and I have Charlotte, and there's Rob and Charlotte. It doesn't matter. And then we'll get rid of this credit card debt. And then we have her second mortgage, this home equity line of credit, which has a minimum monthly payment of $955. So what we're going to do here to see if it's in cash flows, we're going to go to retirement. And then we're going to go to cash flows to see if it shows up there. Hey, right on, Scooby-Doo. No, I don't know if they do notifications. I'm not sure how that works, but that's okay. Because I was literally just doing this, and I wanted to do it last night, but I figured I'd do it now. So if you all have questions on Right Capital specifically, let me know. So I want to see going back to what I want to see. I want to see how the information on the debt relates into the cash flows. Because remember, everything revolves around cash flows. So we got two loans here. One, I put nothing for a monthly payment in. Actually, I don't think I put anything. So we got minimum monthly payments of $955 plus $1074. So her monthly debt payments, Pablo's going crazy. It should be about $2,000 a month. So I'm going to go to retirement, cash flows. Such a nugget. And then I'm going to go to, let's see, expenses. And it should be broken down to debt. Yeah, let's see. Second mortgage right there. Oops. All right, so we got the second mortgage right there. All right, and then it should be housing. Yeah, housing. Okay, gotcha. So we have, all right, there it is. Sweet. So we got housing, which is her primary house that she has a first mortgage on right here, and that's the first mortgage principal, first mortgage interest. All right, that's cool, man. And then the second one, the debt is for the second line of the home equity line or loan that she has. And it doesn't break it out to interest. It doesn't, it just breaks out to second mortgage. Let's see when this, okay, then there we go. Then it gets paid off, but doesn't amortize it. So that's interesting. I did not know that. So that's good. That doesn't amortize it. So I like that actually. That's, I'm just looking real quick. So we got principal. I wonder if we have 45, it's paying $4,500 a year against principal, then 47, 49. And you can see the debt interest is going down, and it gets right here is when it goes from more debt to interest, more principal, more interest to principal, and here's more principal to debt. That's interesting. All right. I want to try something here. I wonder if we make, one second. I wonder if we make a payment. How do you make and I don't know how to do that. So let's just say we want to make a payment. We're going to make a payment on the mortgage goals. So by the way, if you want to prepay the mortgage, you just click on early payoff calendar year. And let me show you what I'm talking about. So let's just say we want to prepay out this mortgage. We want to prepay the second mortgage. We're going to pay it off in 2022. Let me show you this. This is pretty interesting, actually. We're going to prepay this in 2022. Watch what happens here. Hey, what's going on, Windsor? All right, so watch this. We're going to prepay in 2022. So we're going to go to retirement. And then we're going to go to cash flows. Hold on just a second. And we're going to go to net worth. I think net worth. Let's see here. Let's go to accounts because it's got to come from her withdrawal. Yeah, here it is right there. There it is. Oops, wrong one. Right there. Yep. It takes it from her IRA. Look at that. Isn't that interesting? So net cash flows, it took it from her IRA to pay off the house in 2022. Withdrawals from accounts, 181. So it cost her, I guess, $16,000 in taxes to take that money out in order to pay off the mortgage. That's pretty interesting. So we go to right here, expenses. Yeah, look at it. No, it costs a whole lot more than $16,000. Her debt was $139,000. That's on a second mortgage. So in 2022, she owed $139,000 on that mortgage, and she took out, but she took out how much from her tax from her ending balance? But she took out $181,000 from the IRA in which to pay the $135,000, something like that she owed. That's interesting. And then if we go back to a summary, and we go to taxes, oops, 2022, there it is, $50,000 in taxes to the feds. That's interesting. So that was pretty interesting. I like doing that because it just shows you, if you go to tax, watch, you're going to see this big jump here. Yeah, look at that. That's the tax you took out to pay off the mortgage. I get that question a lot. Should I pay off my mortgage? Well, in this case, your mortgage was $134,000 and it cost you $50,000 in taxes in which to pay it off. So I don't think that's a good idea at all. Let me just see if any. All right. Yeah, I don't think that's a good idea at all. That's interesting. So we don't want to do that. So we're going to go back to profile and we're going to go back to here, loan. And then how to change her. Oh, current, we want to go. Oh, don't forget, guys. So if you go to, so you're under dashboard, you go to retirement, you go down here to action items. You got to click this action items thing. If you click this action items thing, you'll get these slider bars and drop down boxes and whatnot. All right. So just make sure you do that. You don't get this edit thing right here. Only I do, but I don't ever use it because it doesn't, there's not much it can let you to do. And I don't know what the debt strategy thing is, to be honest. I'm not sure what that does. I've yet to see what this means. I've yet to figure it out. So if someone can figure that out, I'd like to hear it, but I just don't know what it does. So I just keep it in there because I figure someone one of these days will figure it out. Anyways, that's interesting to me. So if we go to cash flows again, so that didn't, go to cash flows here, proposed plan. Let's go to current plan. All right. And you'll see that green thing going across there. That means it's changing. And let's go to tax on the current plan. Yeah, okay. So we had her paying off. Okay, gotcha. So let's go back to profile. Loan. And we'll just get rid of that. No early payoff. And let's see what it did to the assumptions here. Yeah, okay. Still at an 81% probability of success, but it dropped it from, I think it was 460 or 406 before to 559. And that just means she has a liquid net worth of at her death here at 559, whereas before I think is more than 500. Median, by the way, median just means half of it. She has more and half the time she has less. That's pretty interesting to me. Yeah, okay, right on, Scooby. So my man Scooby says those proposals are elsewhere on the debt flows. That's interesting. So I'm go back to profile. We had no early payoff on that first mortgage, but you can if you want. So here we got an early payoff. She's paying off her mortgage in 2019 on her first. This is her first mortgage, And here is no early payoff. So let's have this guy no early payoff too, and just see what it looks like. And this is what I do. I just go back and forth. I mean, it's nothing fancy. You know, and there you got, okay, gotcha. So it's basically saying, and this is the end. So again, I want to share with you real quick. If you look at the cash flows on this stuff, guys and folks, it's only for year over year. So don't have partial year cash flows in the tables. Now it's partial year cash flows certainly in the scenarios that are running behind this, but you can only see in the table year to year cash flows. It doesn't give you partial year cash flows in the tables, but it does say partial year cash flow tables, if that makes sense. eMoney was one of the other softwares I use, and they do, you know, they can give you partial years and year over year, but Right Capital just gives you 2020. So whatever happened in 2019, we don't know. We don't know. So it starts everything as if it were 2020 once you factor in the cash flows that are happening in 2019. So here she got 417 in her IRA, and that's it right there. And she'll get the growth of that. But we have her paying off her mortgage at the end of, oh, we didn't. Okay, never mind. We got rid of that. Okay, cool. Good. All right, so let's just go back to retirement. Yeah, okay. All right, good. All right, so let's I want to show you how I do Roth conversions and annuities too. So let's just say we go to profile, and we have an investment, $400,000 roughly. We're going to take 200,000 of that and annuitize it. And so I'm just going to say she'll get $200,000. She'll get $200,000 times 5.5%, which is $11,000 a year. So what we're going to do is we're going to delete this by 2. So 1439 divided by 2 to make it 720 shares. So she has 720 shares left. And then we're going to add an account, and we're going to add, I think it's under income, if I'm not mistaken. And I'm going to add income. Yeah, right there. And we're going to add annuity, but I don't think that's what I want. Yeah, all right, there we go. So we got annuity starts right there, life only. We're not going to have a customized increase. Our annual amount is $11,000. There we go, sweet. And then it's going to be for life. Okay, that's perfect. So that's all I do. Now, exclusion ratio, you always want your exclusion ratio at 0 if it's coming from an IRA. That means 100% of the annuity is going to be taxable. If the annuity is coming from a non-IRA, let's say it's a brokerage account in which you have a cost basis, you got to take your cost basis and compare it to so what happens, they have these exclusion ratios. So basically what's going to happen is when you have the annuity, Pablo, stop. When you have the annuity, your annuity company will say, hey, you're putting $200,000 in a non-IRA annuity. They'll tell you what your exclusion ratio is once you do the contract, if that makes sense. So just for simplicity, let's say you're getting $200,000 a year, and over the course of your life expectancy, they're expecting to pay you $400,000. You're doing an annuity for $200,000. That's your cost basis. And over the course of your life expectancy, they're expecting to pay you $400,000. So you put 200,000 in, that's your basis. 400,000 is when you're going to get back. Your exclusion ratio in that case is 50%. All right. So 50% of your income from the annuity is tax free because it's literally a return of principal. In this case, because it's an IRA and it's all taxable as ordinary income, we have no exclusion ratio at all, if that makes sense. So we're going to click on that right there. And there is no survivor, so it won't matter. And we can just get rid of this right here because there is no spousal. All right, so in this case, we have an exclusion ratio of nothing. Everything's taxable. We have an annuity at 100% taxable as ordinary income, but it's paying $11,000 a year. So we go to cash retirement. Now I just got rid of a pretty significant Social Security thing, so this should drop it quite a bit here. Oh, not much. It's just 78%. But if we look at cash flows, we're going to see income flows. That's the annuity. And then when Social Security kicks in, she's going to get that much right there, 40,000. So plus the annuity, she can have income flows of $51,000. Imagine taxes aren't much. Yeah, not much in terms of tax payments. All right. Real quick, let's see what's going on here. She still has, then she has her RMD right here. All right. So she has 11,000 annuity, 40,000 Social Security. And then she's got, this from her planned distribution, which is her RMD. And her tax man is $2,000. I'm just curious. Let's just take a look at the tax man. Yeah. So her effective tax rate, is below 10% until the day she dies. So that's not so bad. Let's just take a look at the 1040. And we'll go to 2020. Well, she's not on Social Security yet. We're going to fast forward. We'll just say to 2025. Yeah, so here you go. $45,000 of Social Security benefits, of which only 13,000 are subject to tax. She has 21,000 in total IRA distributions, the 11,000 from the annuity, and it looks like another 10,000 from the IRA distributions. So we have total income 45 plus 21. That's $66,000, of which only half that is subject is half that is her AGI right there. Take out her standard deduction of $15,000, and only $19,000 of her roughly $70,000 is subject to income tax. $2,000 on $70,000 of income. That's not so bad. Not so bad at all. All right. So I'm curious though. Let's see if we've got any. All right. Oh yeah, no, you can find a 5% annuity. Yeah, man. Hell, let's we'll go to hold on a sec. We'll go to Schwab. Bear with me just a second. If I can find, how do I get the oops. Oh, I gotta go back to the, hold on a sec. How do I go back to get the thing up there, man? Not sure how to get the back up there. All right. Mute. All right. Well, I was going to go to Schwab. I'm not sure how to get my that back up there where the screen share was. I could show you guys. That's weird. All right. So we're going to go over here. Oops. Oops. Oh, that doesn't do anything. Anyway, I don't know how to. Yeah, I don't know. I don't know how to get the thing back where I can actually show you. Oh, right here, maybe. Nope, that's not it. Where's the window so I can? I don't know, man. That's weird. View. Oh. Oops. View. There we go. All right, cool. Hold on a sec. All right, so bear with me just a second. I'm gonna go to let's go to Schwab.com. Annuities. Oops. All right, so we go to annuities. All right, so now I gotta go back here. All right, so we're gonna go to Schwab.com annuities. All right, cool. There we go. And we're gonna hide this guy. So, okay. Now we're at Schwab.com annuities, and we're gonna go to single premium immediate annuities. Let's click on this guy right here. And we're gonna go to, oh, here we go. Scroll down. And we're going to go to, where's the thing to tell you how much the income, annuity income estimator. There we go. Jeez Louise, could they make that any harder? All right. So I'm at Schwab.com for my lifetime. Amount invested, we're going to say $100,000 $1,000. All right. And we'll say my date of birth is 19. We're going to say 19. We're going to say I'm 68 years old. So 2001-19, my 68, 0151, right there. Perfect. We'll say 8/17/51, or in this case, 01/01/1951. And we're going to say I'm a female, and we're going to say I'm in Georgia. We'll just say Alabama. All right, so let's hit next. Income start date. We'll say 1/1/2020. All right. So here you go. So we got the monthly income. That's single life with period certain. That's a 10-year period certain or 20-year period certain. That's 477 times 12. That's 5.7% right there, man. Hold on a sec. Oops. Well, what happened? Okay. Yeah, I don't know what happened to my face there, but anyway, that's I gotta figure out how to use this thing. Jeez, man. That's not what I'm looking for. Figure out how to use a screen share thing. I lost it. Anyway, so that's that right there is a single life with 10 years certain is 531. Again, this is for a 68-year-old person. 531 times 12. That's 6.3% payout ratio. That's not bad. Now, obviously, this person is going to be older than you, brother, but yeah, that's pretty good. I don't know what happened to my screen share. So anyway, let me go back. So that's how you do the income annuity thing right there. Is you just say, okay, but you got to make sure if you're going to do it, you take the money out of the investments in which to do the income annuity, if that makes sense. And the income annuity estimator, I always like this right here, the single life with 20-year period certain. But if I'm 68, I'll probably do a single life with 10-year period certain, which means you'll get income for 10 years or your life, whichever is longer. Just be advised, whichever is longer. In fact, it's interesting. The single life with 10-year period certain actually pays more than a single life only, which is kind of interesting to me. So just keep that in the back of your mind. Somebody had any other thoughts or questions on here? Yeah, not much. Okay. Seemed like I had one other thing I wanted to share with you guys here. We talked about mortgage. We talked about how to do a Roth conversions here. So remember, in this case, we go to the, I want to show you something else too. Investments. You can see here now you guys don't have access to target allocation in terms of the drop down box. So if you look here, the target allocation for 100% US is 7.5% rate of return with a standard deviation of 17.3. If you do bonds, it's 3% with a standard deviation of 4.6. Most aggressive is 5.9 because it's diversified. So you can see all that. What that means is if you go to profile and then you go down to, go to retirement, excuse me, and you want to mess around with this current allocation, you simply, current allocation, U.S. stock market, which is already what she's in right now because she has 100% S&P 500. And then you go down to profile, then you go down to refresh. So in this case, you say, let me go to aggressive, which will be more diversified than U.S. stock market. And it drops the percentage down a little bit because your rates of return are lower. No other way around that. You go to balanced. It's going to drop the rates of return down. And so you can see that because it's just not as good as performance for sure. Then you go to cash flows. And you go to, I think it's net worth. No, it's invested asset. Yeah, right here, portfolio return. So here she started the year with $194,000. She took out $10,000, but she had $14,000 of portfolio return. So you can get a pretty good gauge of what kind of return that would be. So you always want to make sure the portfolio return has some decent amount of money in there, or else you're all sitting in cash, and we don't want that. So in this case, I wonder if I change this to propose. Let's see what happens. We got the 15. Yeah, so it changed it to propose quite a bit because proposed plan is going to be right here, a balanced asset allocation. I might need to do all this just not one fell swoop, but just different perspectives here. Because each, see the balance right there. I might need to just go and say, hey, this is how it works for, little bites and chunks instead of doing the whole thing in one fell swoop. I'm doing here. Just say, okay, if you want to get a different rate of return, even though you can't change this right here on this target allocation, you can by going to retirement analysis and scrolling down here, click on this action items button, and then doing changing this right here. So if you go to preservation, for instance, that's like 2080, and you'll see it drops down like significantly here where you run out of money. Then we go to cash flows, and you go to, I think it's investment account. Yeah, so here you can see her portfolio returns aren't very high just because she's not making, because they're a conservative portfolio. So she's getting about 3% a year. If we go down here to conservative, I think it's about 3% or 4.2. Anyway, a lot going on there. I guess. Last thing I want to show you here, we go to profile and you go to income, and then you go to Roth conversions. All right, so we want to make sure that this right here, current rollover is you want to make sure as you're rolling over to Roth, converting it to Roth, or if you're not, either way, you want to make sure that this button is checked correctly. And you also want to make sure you're doing it from now until the right calendar year, but you also want to make sure it's coming out of the right account. If it's coming out of your Roth 401k, you got to put Roth 401k. If it's coming out of 401k, you got to put 401k. If it's coming out of IRA, you got to do like that. So you got to make sure it's done for the right account. And then let's just say she does 25,000 a year until she's basically, until the account is exhausted. Then you come up here to retirement. I know I'm flying through this, but the whole point about this is just to give you some stuff that you can kind of mess around. In this case, well, one sec. We go to current strategy, current allocation. Yeah, there we go. So in this case, she has a 76 probability of success with $183,000 in money left over. Good boy, of liquid assets. And you can see that median line right there. I do like those future dollars too, because they'll drop. You'll see, when you factor in inflation, it does drop. This is money that you're looking at, hey, $77,000 in today's dollars. But if you look at it in the future dollars, $77,000 looks like a whole lot more. You're like, oh man, 131,000. Yeah, but after inflation, it's only 77,000. Curious what the tax scenario looks like. Yeah, and then you can see here, she has no tax. The only reason she has 1% tax, hey, buddy, is because Pablo. The only reason she has 1 or 2% tax is because she has that annuity income. Anyway, I hope this helps. Lots going on here, and like I said, I'll probably be doing this on a regular basis just because I find Right Cap will be incredibly. I think it's incredibly fluid. I love this. I don't know why I can't get my screen back up where I can see myself anymore. That's weird. So obviously I'm screwing up something with Zoom. Show all options. Okay. Anyway, I'll have to figure that out. That's odd to me. But anyway, hope this helps. I hope you like the software. I love it, man. I think it's freaking fantastic. I'm a big fan of this, and just so much to use here. I'm just scratching the surface. Now I use this on a regular basis, but just use it and take your time with it. It's freaking awesome. So if you have any other questions, let me know. Put them in the show notes, put them in the comments, and we'll address them as the time goes. I'll probably doing a Right Stream live. A Right Capital live stream once a week going forward. I'll put a note on there when I'll do those on a regular basis. But I'd taken Pablo for a walk today, and I was like, let me just jump on because I meant to do it yesterday. I did not. All right, my friends, we'll see you guys later. Have a good one now. Thanks now. So I go back to meeting? Yeah, I don't even know what I'm doing. Oh, Zoom right there. Oh, view right there. Okay, cool. Show video panel. There we go. Hey, how did I do that? I don't think I'm signed out here. So I went to here. That's what you do. All right, cool. There we go. There we go. There we go. Cool. All right. See you guys.